After reaching a 5-month high against the US dollar on September 25th, the Canadian dollar experienced a pullback, shedding nearly 5% of its value over the subsequent 7 weeks. Now, the shift was largely driven by the narrative of rising US interest rates, which began to gain momentum following the Federal Reserve's 50 basis point cut on September 18th. Now, the 2-year rate differentials between the US and Canada widened considerably from late September, with Canadian rates going from 2.9% to 3.17%, while US 2-year Treasury yields went from 3.6 to 4.35 in the same time period. Perhaps this reflects the more favorable inflation picture in Canada, with September year-over-year Canadian CPI coming in at 1.6% compared to the 2.4% US rate for the month. Now the inflation picture has received some additional clues, with the US CPI rising to 2.6% for October, and then the Canadian CPI coming in at a higher than expected 2.0% on November 19th. The slight surprise in Canadian inflation helped the Canadian dollar stage a small 1% bounce from its 4-year low against the US dollar on November 15th. Now, the next round of significant domestic data comes on November 27th with GDP and PCE, which is considered to be the Fed's favorite inflation measure. If the market starts to believe that inflation may be rising in Canada, at the same time it's declining in the US, the Canadian dollar could shake the weakness of the last 2 months. Now, CME Group offers 3 different sized currency contracts, the standard, the mini, and the micro. In order to match a trader up with their preferred risk tolerance, we're going to be using the micro in these examples. If a trader believes that the recent strength in the Canadian dollar could continue, they could express that by buying the December micro Canadian dollar futures contract at 0.7160 and target a move to the September lows of 0.7340. Now, a stop for this trade could be placed below at 0.7040. This trade can make $180 if the target is reached and risks $120 if you're stopped at your level. Now, if a trader believes that the Canadian dollar could soon resume its downtrend, they could sell the December micro Canadian dollar futures contract at 0.7160 and target a move to the psychological level of 0.7000. Now, a stop for this trade could be placed above at 0.7250. This trade can make $160 if the target is reached and risks $90 if you're stopped out of your level.